The Fed just dropped rates, so here's what it means for you. In a highly anticipated move, the Federal Reserve has officially lowered interest rates, signaling a shift in monetary policy aimed at supporting economic growth and cooling inflation. For consumers, homeowners, and investors alike, this decision has far-reaching implications, especially for the real estate and mortgage markets. So, why did the Fed lower the rates? After a series of aggressive hikes over the past 2 years to combat inflation, the Fed is now seeing signs that inflation is moderating and there is economic conditions that are stabilizing. By lowering the federal funds rate, the Fed aims to make borrowing more affordable for consumers and businesses, stimulate the economy, right? We want more activity, and avoid pushing the economy into a recession. Lower interest rates typically lead to lower costs on mortgage, car loans, credit cards, and business financing, boosting spending power across the board. What this means for home buyers. If you've been sitting on the sidelines waiting for a better time to buy a home, this could be the window you've been waiting for. Lower mortgage rates equal lower monthly payments. Increased affordability equals greater purchasing power. More inventory movement, potentially less competition, and this rate cut is expected to trigger a wave of refinancing and new purchase activity, particularly for first-time home buyers who have been priced out of the market by higher rates. For sellers, more buyers, more demand. When rates drop, buyer confidence rises. That's good news for homeowners thinking about selling. More qualified buyers enter into the market. Homes become more attractive with lower monthly payments. Demand can drive stronger offers and faster sales. If you've been waiting for the right market, now might be your time and maybe a better opportunity for you to take action before the competition increases and inventory levels shift. For investors, maybe it's time to rethink that leverage. Lower borrowing costs can enhance the return on real estate investments, especially if you're using financing as part of your strategy. Refinance high interest rate investment properties. Acquire new assets with improved cash flow potential. Take advantage of the spread between rental yields and loan costs. Commercial real estate and multifamily housing investors are especially poised to benefit as rate cuts drive both value and appreciation and tenant demand. So what's next? While this move marks a pivotal shift in monetary policy, experts suggest the Fed will continue to evaluate economic data before making further cuts. It's not likely we'll return to pandemic era ultra low rates, but we're certainly heading in a more favorable direction for borrowers. Bottom line, the Fed's rate cut is more than just a headline. It's a signal of opportunity. Whether you're buying your first home, upgrading, selling, investing, this shift in the financial landscape could be the catalyst to move forward. If you're wondering how this change affects your personal situation, connect with a trusted real estate or mortgage advisor, like the Coffey Group powered by Lucido Global at Keller Williams, to run numbers and create a strategy that fits your specific goals.